Mother Teresa's version of Ken M. Keith's Paradoxical Commandments. It's on the wall in a home for children in Calcutta. It says this. It says, people are often unreasonable, irrational, and self-centered. Forgive them anyway. If you are kind, people may accuse you of selfish, ulterior motives. Be kind anyway. If you are successful, you will win some unfaithful friends and some genuine enemies. Succeed anyway.
Will you grab your mic?
Okay now?
Yeah.
I'll move it closer.
Yeah, you're good.
If you are honest and sincere, people may deceive you. Be honest and sincere anyway. What you spend years creating, others can destroy overnight. Create anyway. If you find serenity and happiness, some may be jealous. Be happy anyway. The good you do today will often be forgotten. Do good anyway. Give the best you have, and it will never be enough. Give your best anyway. In the final analysis, it is between you and God. It was never between you and them anyway. I like that thought. Okay, so what we've done is we've built a structure, built that foundation on personal finance. We started worked on your savings, income, and expense plans. We started working on your financial statements, started working on your consumer and debt loans, and today we're hitting taxes. I hate to admit it, taxes are, for a finance guy, remember I got a C+ in accounting, and that's why I went finance. So taxes is really kind of an interesting thing, and I have to admit, I like teaching this. So here's your section on taxes. What I want, what's your vision and your goals for your taxes? There's the template there. What tax form and tax strategies did you use last year? Which one did most of you use last year? 1040 easy, yeah, 1040. What was your marginal and your average tax rates? So you need to know those things. And you can do average tax rates on taxable income. I usually like it on gross income. It just helps me to think a little better. What are your plans and strategies for the future? And what else can and should you do to reduce your tax bill to Uncle Sam? And finally, what are your constraints and accountability? We put together this little worksheet for the people who don't spend much time with taxes. And really all it is, there's a 6-step process. Determine your total income, calculate your adjusted gross income, calculate taxable income, determine total tax liability, and then determine tax liability after credits and calculate the taxes due. So it's just a nice little spreadsheet. Fun thing about this is it also calculates what percent of the credits are refundable and non-refundable. So it does that analysis for you. So it's just a little tool to help you out, and we'll actually use it in class today. Okay, so here's an example. This is the case we're going to do, and we'll answer it at the end of class. Married, filing out taxes. They have 4 children, 3 under 17. Why is 3 under 17 important? Okay, child tax credit, that's right. So Isaac said that too. 5,000 to a traditional 401k, 25 to a flexible spending plan. State and local taxes were 11,000. You can only deduct medical bills in excess of 10% of AGI, state taxes less than or equal to 10,000. And then you got your standard deduction, your child tax credit, and you've got the tax rates. Who here could not do this problem right now, just based on what you know right now? A couple of you, a couple of the honest ones. Now, accountants, please don't read too much into this. No AMT, no. Realize this is really basic stuff here. But I'd like to, even the accountants, you guys need to think about what are your strategies? What are your plans and strategies to accomplish? Because a lot of times we know a lot about taxes, but we haven't thought, how do we apply that in our lives? Okay, so why should we be planning for our taxes? Nathan?
Because there's ways to maximize after-tax benefits.
Right, maximize after-tax benefits. I once asked the question, how do you reduce your taxes? And someone said, quit your work. So then I replied, that's the question. How do you minimize your taxes for a given level of income? And that's what we do. Are there any areas of your life that taxes don't impact? funny, we spend 6 weeks every summer in Nauvoo. And if you go into Nauvoo and you see these old historical houses, you'll notice that the closets are only about 14 inches. They're really narrow. And I didn't understand that until you found if it was more than 14 inches, it was considered another room and you were taxed. Joseph Smith's time, Joseph Smith's parents, what they would do is they'd build their house on the county line. So it would straddle two places, and that way they could pay the lower taxes of whichever county they wanted. We also know which side of the house Joseph was born on because of, we know what county he was born into. So it's interesting that taxes have had an impact, and they continue to have an impact on us here. Anyone heard the term Tax Freedom Day? What is Tax Freedom Day?
The day with no sales tax?
No, it's actually the day on average. Go ahead, Michael.
I think it's the day at what point of the year that you actually start keeping some of your money.
That's right. It's the point of the year that you actually start keeping some of your money. I think it's really appropriate that it's April 16th in 2019. So I think that's fun. You can actually see how it's changed over time. But that's the time, on average, you stop working for the government and you start government and local taxes and you start working for yourself. Is that an important date? Yeah, and what that tells you is roughly, taxes are one of the biggest expenses you will have throughout the year. So we probably should be wise in what we do here.
So if it's May, does that mean you're still paying last year's taxes?
So what's the Lord told us about taxes? What have our leaders said? There actually was a time where some people came through and said because income tax was not in the original Constitution, you don't have to pay your taxes. And the church came down really heavy. Be subject to the powers that be, and President Lee said, trying to lead some who are weak and weary, who are taking the law into their own hands by refusing to pay their income taxes. So we are responsible to pay it. It's interesting, I've spent some time in some wonderful places, basically emerging market countries. I've spent time in Vietnam, Cambodia, India, Pakistan, Sri Lanka, a number of these different places there. And we have wonderful infrastructure, roads that you can drive in, clean water and things like that. So even though we do pay our taxes, we do have lots of things to be thankful for. Yes?
Okay, this is a little bit of my soapbox, that's Obama, but, he was so socialistic. But what he never told you is that the countries that do socialism pay about 80%
Yeah.
in taxes. And, it's just not free.
Yeah.
And you do want to pay it. My neighbor actually ended up in prison.
Yeah.
Tax. And I don't think it was intentional.
Yeah.
It's easy to justify, so you need to be careful.
Yeah, be careful. Again, our vision is we pay every penny we owe, or every dollar we owe, and not a penny more. And we need to be wise stewards over that too. So what are the principles? I think that just led into it. Pay every dollar you know and not a penny more. Are taxes a voluntary contribution or a forced exaction?
It's voluntary.
You want to pay your taxes with a smile. At least you don't have to use money. Are taxes a voluntary contribution or a forced exaction? The fact that you can go to jail if you don't do it, does that say it's voluntary?
It's a voluntary reporting system.
Right, but it's a forced exaction.
Yeah.
It is. So principles of tax management. First two are always easy because they're always the same. Know yourself, your vision, your goals. Seek, receive, and act on the Spirit's guidance. Other principles? Yeah, Isaac.
Keep records of documents throughout the year.
Keep good records for tax and other purposes. How long do you need to keep your records? 7 years, that's right. Other principles. Here's some that I've come up with. Understand the tax system so you can make wise decisions. Get good help too. One of the neat things you guys have here is the Vita Lab. You go to vita.byu.edu. It's an amazing thing. So what I do is once I go through my problems, I have someone at the Vita Lab look over it. They found ways that they can even save more money. So you can actually see it on the problems there. But the downside is they don't have professors. They only help students. So once winter semester comes, I'd encourage you to use them. It's a good resource. So going from our principles to our doctrines. Interesting, those top 5: identity, obedience, stewardship, agency, and accountability. Again, it was neat with the prophet here. Remember what his first truth was? You're a child of God. It's identity. So the first thing that he talked about was the importance of knowing yourself, knowing who you are. So we're not just paying our taxes. What are we doing? Heavenly parents, identity, trying to live worthy of the Spirit. It was learning important information about the tax system, wisely keeping records, and getting good help when needed. Think of, again, if we will tend to look at things if we will raise our vision, it will increase our motivation. Okay, questions on the importance of principles? Okay, let's take you through just a quick process. So how do you do your taxes? And we're going to do just the federal process just because our state's different on the amount of state taxes. Yeah. We actually have a graph here that has the state taxes in every state. But start with your income, all sources, gives you your total income. Then what you do is subtract your adjustments, or AGI deductions gives you your AGI. And it's interesting, some things are an exclusion and some things are adjustments. And it's not always intuitive which of those things are. Subtract the greater of your standard or itemized deductions to get your taxable income. And you'll calculate your tax in the tax table, gives you your tentative tax. Again, minus any credits gives you the total tax owed, and minus what you've paid gives the balance due or refund. So it's a 6-step process, and it's something that we need to understand so we can play the game to do well. Number 1, total income. It's just all income unless specifically excluded or deferred. So how about gambling income? Is that considered income? Tips, are those considered income? Yeah. How about if you rob a bank? Is that considered income? Actually. And then what are the things that are exclusions? Contributions to qualified retirement accounts. So a 401k or a 403b, those are excluded. Gifts and inheritance. Life insurance proceeds. If you're the beneficiary of a life insurance contract, that all comes to you income tax free. Grants not in excess of college expenses. If you have $10,000 of college expenses and you have $8,000 in grants, that's not included. But if you have $10,000 in college expenses and $12,000 in grants, you'd have to do that. You'd have to add that extra $2,000 there. Municipal bond interest. Muni bond interest is tax. It's an exclusion. And, my wife and I have 529 plans and education IRAs for our kids. And the interest on those is an exclusion as well. So that gives us our total income. And then our adjustments, it's kind of interesting. An IRA is an adjustment, but a 401k is an exclusion. Don't ask me why, but that's kind of what. So qualified savings account. So we have a flexible spending with here DMBA. These cards used to be red. It's the first year they've been blue. So what I can do is I can pay medical expenses with pre-tax dollars. Is that a good deal? Yeah, it is. Non-Roth individual retirement accounts, any contributions to health savings accounts. Those are all before tax. Student loan interest, tuition fees deduction. If you're self-employed, you can deduct half of your self-employment tax. Any losses, net capital losses, proprietorship, and real estate losses, you can deduct those up to a certain amount as well. So these are all adjustments to get you to your adjusted gross income. And what I've just given you the 1040 form, which is really short now. And then you can take the larger of the standard deduction or your itemized deduction. Notice what happened in 2018. What was the big change in 2018? What did they do?
They took away personal and dependency exemptions.
So they took away the exemptions and then they doubled the standard. Yeah, so people with large families, it hurt. Yeah. But that's the laws there too. Or you can itemize your deduction. So any charitable contributions. So, and it's also in cash, in kind, or mileage. Yeah, you serve as a scoutmaster, you don't get reimbursed for your miles, you can take that. A young women's leader. You go to girls' camp, you don't get reimbursed, you can get mileage for there. I used to be a high council speaker, and I would be in Oakland twice a week, so I could deduct those miles there too. How about mileage going to church? Can you deduct that? No, you can't. Home mortgage interest, medical expenses greater than 10% of AGI. Either state and local taxes or state and local general sales taxes, property taxes, but it's only up to $10,000. Anything beyond that, you don't get a deduction. And then mileage deduction, it depends on usage. Is it charitable? Is it business? Or is it medical? You can actually see how those have changed over time.
Is medical only if it's not reimbursed by the flex spend?
Tax people support here?
Say that again?
So he's saying if you like if you're driving to the doctor, like this would be really significant when my grandparents lived with me, right? Because I'm driving to the doctor all the time. But I had no idea. But so if you're driving, but you're getting to medical appointments, but you're getting reimbursed from a flex spending account, can you still deduct the medical?
No.
No.
If you're getting reimbursed.
If you're getting reimbursed, you can't. How about, can you do that if you're taking your parents to the hospital? Could you deduct that?
Does that depend on if you're their it depends on like if you're their caregiver.
If you're like
Okay.
the primary caregiver.
Okay.
How does the business mileage deduction work? If I take a flight to like Reno right now, or if I drive, is there a difference?
Well, some businesses will have you do things on your dime. And if you're doing things on your dime for, your employer and you're not being reimbursed, those type of things, that's where.
Right, but is there a difference between like flight or driving?
Well, if the employer is making you pay for a flight, which is really uncommon, bad
Yeah.
employer, then yeah. But more than likely that's never going to happen because your employer, if they're going to send you somewhere, they're going to pay for your flight.
Yeah.
More than likely.
So you just deduct your flight cost and you would multiply by that. It's when you're driving your car, you multiply by that.
Yeah.
Okay. Then you use the tax tables. Notice this, it's progressive. The tax is progressive. Between 0 and 19.4, it's 10%. Between 19.4 and this, 12%. So as you make more income, you pay more taxes. Here's a question. Do we want to target our tax rates in retirement? Is that a good idea? Probably. So maybe we should think about some of those things there too. And then our tax credits. So your two different types of credits. Credits are worth significantly more. A deduction, say you're in the 25% marginal tax bracket. If you've got $1 in deduction, how much does that save you? Times 25% marginal tax bracket, it'll save you 25 cents. If you have a credit, how much will you save you? It's a dollar for dollar reduction. Now credits are two types. They're refundable. What that means is even if the amount is more than your tax liability, you'll still get money back, or non-refundable, which was they'll refund it just to your tax liability. Here's some of the key ones. We have another PowerPoint that goes into detail on these key tax credits for students. So I encourage you to look at that if you want. But American Opportunity Credit, Lifetime Learning Credit, Earned Income Tax Credit, Child Tax Credit. And then there's some other ones for non-students, retirement savings contribution, residential foreign tax credit, things like this. If you have international stocks in your portfolio, such as an international index fund, you may also have some of the foreign tax credit from the distributions on that mutual fund. And then taxable income, tax withheld and the amount withhold, just some different places where you'll see that on that form. And then the last one is just minus taxes already paid equal your balance due. So questions on the federal tax process, that's just a really quick taking you through that. Okay, let's talk about tax features and strategies to review tax. What are the four main kinds of taxes? They really fall under four categories. First of all, income taxes. Lots of different ones. A couple of key points. You need to understand what's your marginal tax rate. That is the tax rate on the next dollar that you earn. We also have the average tax rate, which is the amount of every dollar paid for by federal income taxes. And so what we try to do that, accountants like to do that on taxable income, and finance people like to do it on gross income. So just kind of look and see what we ask. And then your effective marginal tax rate that takes into account state, local, and federal taxes. We have capital gains tax. These are nice because you can postpone taxes until you sell the asset. Now, the downside of this, if you buy a mutual fund that does a lot of distributions or a stock that has dividends, you cannot postpone the dividends or the distributions. You pay taxes on those every year, but you can postpone, basically the taxes from the capital gains taxes there. So realize too, there's two different types. If you've held it for more than 366 days, that's considered a long-term capital gain and you get a preferential treatment. Shorter terms are less than 366 days. Realize also with dividends, there's a thing called qualified dividends, and there's this weird formula that we'll talk about when we get into the investing section there too. Realize the government has kind of changed the way you pay capital gains tax. So it used to be mainly based on your tax brackets, but now they've actually changed things here too. So once tax brackets up to a certain bit, but once you hit 39.38, all of a sudden your tax capital gains and dividends go to 15%. Once you hit this, they run up to 20%. And notice too, depending on your income, then your Medicare earned income and investment income taxes increase too. So you can see your rate with capital gains and Medicare can be up to almost 30%. So realize these things happen as well. You do have just some investing insights. What does it tell you? Invest long term. You can defer those taxes as long as possible. Last year we purchased into an equestrian park, and I have to admit I sold some shares, and I'd owned them for like 20 years, and so about half of that was capital gains, and needless to say, it hit pretty hard. So be aware of that. Buy for the long term. Keep costs low. And again, I like low turnover, tax efficient mutual funds, where you basically get the performance, and they're just very, very inexpensive. Home ownership insights, gains up to $500,000 per couple or $250,000 per person. So just be wise on some of these things here. And then we have income-based taxes, Social Security or FICA tax. So realize that's 6.2% of your gross salary. Medicare's 1.45. Together those two, I just call those Social Security taxes, and it gives you 7.65%. Realize if you're self-employed, you have to pay the whole 15.3%, but then you get the benefit of half of that you can deduct as a deduction. State and local taxes. Realize that not every state has state taxes. Here's the list here. In fact, Alaska, you actually make money. They'll send money to you if you live there too. Nevada, Texas, Wyoming, just zero taxes. You can see Utah's about 4.95% right now. So it's just kind of an interesting thing. So depending on where you live, so California is a progressive tax. So it can be up to 13.3%. You can almost pay much in California taxes as you do your federal taxes. So be wise there, and then you can see some of the other ones are pretty high too. When we moved from California to Utah, back then it was only about 10%, but I got like a 3 or 4% raise just moving to Utah because my taxes dropped. My state taxes dropped that amount.
The thing to remember though is that then you're paying different income taxes too. So
Yeah.
Texas is no income tax, but their property tax
It's higher, that's right.
like triple.
Yeah. So what happens is when you have K-1s in different states, you have to pay different state taxes, so it's kind of a pain. And then you got basically your income-based, non-income-based taxes, your sin taxes, real estate property taxes, gift and estate taxes. Okay, so how do you reduce your taxes for a given level of income? So what are some of the best things to do? What would you recommend? If this is one of your largest bills every year, we should be wise. Nathan?
At least for LDS couples who are, paying their tithes,
Uh-huh.
I believe they should bunch, and then they should look into, if you have appreciated investments,
Mhm.
you can donate those as charitable contributions to get a stepped-up basis.
Okay.
So that's at least for like LDS.
So
people.
he just said two different things. So what does it mean when you bunch your deductions? Tyler. You can accelerate. So for example, you can pay 2 years of tithing in 1 year. And what that does is that would probably take you beyond that. The other thing Nathan talked about is you pay your tithes and offerings with in-kind securities. So if you have taxable securities that you've got to gain, let's say you paid $10 for it and they're worth 20. If you sold it to pay your tithes and offerings, how much would you have? Let's assume your capital gains is 15%. So what's your capital gain on that sale of that security? $10. So you've got $10 capital gains, you pay 15%, so you have to pay $1.50, so you'd have $8.50 to go. What happens if you just donate that security to the church? How much capital gains do you have to pay? None. What's your donation valued at? The full $20. So I haven't paid my tithes and offerings in cash in probably 25 years. What's the other benefit of paying your tithes and offerings with appreciated securities? Yeah. How about this? Your target portfolio is 70% equities and 30% bonds. But all of a sudden the equities have done well. Now you're at 80-20. What happens if you sell the equities and buy bonds? Do you have to pay the capital gains on it? Yeah. But what happens if you take those equities and use them to pay your tithes and offerings? And then take your money you would have spent on tithes and offerings and you use it to buy your underweight asset classes. What have you just done? You've just rebalanced your portfolio with zero tax implications. So can we use, things like tithes and offerings as a way to rebalance portfolios? Jenny.
I actually have a question. So, actually, a couple of years ago, I had one of my neighbors come to me, and I think he buys and sells businesses.
Uh-huh.
I'm sure it was a really good year. But he's like, how do I save money on taxes, Jenny? I'm like, I don't know. So what would you say to someone who makes a lot of money buying and selling businesses? How would they save more on taxes?
Do you have to donate stocks and bonds? Could you donate real estate? Yeah, you could. What's the challenge with real estate? How do you value it? So the IRS is very detailed when it comes to the real estate things. What does the church do with it? When you donate stocks and bonds, yeah, the next day they'll sell it. Do you really care what the church does with it? No, my commandment is to pay my tithings. What the church does with it is someone else's responsibility. But the point here is, that's one thing, pay your tithes and offerings with appreciated securities. Now, what about when you get to be an old geezer like me, and you're over age 59 and a half? There's a thing called RMDs, weapons of mass destruction, but it's called required minimum distributions. What are RMDs? Right, so the government gives you this thing, you've got a 401k, tax-deferred accounts, or an IRA. At age 69 and a half, you have to add up all of your tax-deferred accounts, your 401k, 403b, SEP IRA, and then you divide it by what's called your remaining life. And I think at age 69 and a half, it's like 27.4.
Is it 59 and a half or 60?
At 69 and a half. And then at age 70, what you have to do is you have to take that distribution. So whatever, let's just to make the math easy, you have $275,000 in that account. And the remaining life is 27.5. You have to take out $10,000 a year. And if you don't take that out, your penalty is half of your distribution. So it's pretty hefty. So what happens once when you get age 69 and a half? Can you pay your tithes and offerings with appreciated securities? And does that become part of your required minimum distributions? The answer is yes. So just little things that you can do. Other ideas to reduce your taxes legally.
Is that percentage just for tax-deferred accounts?
Right, tax-deferred accounts. Yeah,
So you can
Tyler.
put money in traditional 401k.
Put money in traditional 401ks, SEP IRAs, 403bs, things like that, tax-deferred accounts. Other thoughts? Otherwise, you're just going to have to go through my slides. Nathan.
What are, in your suggestion, starting when you're younger, what are some of the best securities to put your money into so that when you're hitting your mid-range salary in your home, getting those paid off in your 40s, so that you can have the best bunching and paying off your tithes using those securities?
I just use index funds. So the nice thing is I buy an index fund, and my goal is to hold it for 40 years, or until I need to pay my tithes and offerings. Tyler?
There's what's called tax shifting. So
Mhm.
if you have your own business,
Mhm.
you could shift income to your business, so you would have a higher tax by employing your children.
Okay. I'll leave these type of things to the tax people. Realize I'm a finance guy teaching taxes. Okay. So here's just some thoughts. Number one, maximize deductions. We talked about home as a tax shelter. We talked about shifting and bunching deductions. It's a lot harder now that they've increased it to 24/4. Continue to give with tithes and offerings. Keep good records. Health, charitable, moving expenses, including mileage and in-kind donations. Number two, minimize taxes owed. Again, if you can invest long-term and don't buy and sell a whole bunch, you don't pay taxes on it until you sell the asset. So also stock dividends over bond interest, just because stock dividends are taxed at a preferential rate. Again, if you have with your financial assets, utilize a buy and hold strategy. And manage your portfolio on a tax-efficient basis, and we'll actually share that with you when we get into the investing side. Number three, tax-exempt income, muni bond interest. When we came back here, I was complaining because I was only making like 0.7% on my money market mutual fund. So this is in early 2000s. And then my buddy says, well, you ought to look at the tax-free money market mutual funds. So I was making 0.7% in a money market mutual fund, and the tax-free money market mutual fund was making 0.75%. And so I just switched it all into the tax-free account. So realize, take into account those differences, and there's a number of things there. Treasury securities are state tax-free. Medical savings accounts, flexible spending. Pay medical bills with pre-tax dollars too. You can also put money into health savings accounts too, so you don't pay the taxes on those. And we talked about donating to charities with appreciated assets. All of those things work well. You could defer taxes to the future. Again, invest in your 401k or 403b, your tax-deferred accounts. You can eliminate taxes by investing in a Roth IRA. So here's that quick question. If your goal is to maximum the amount of money saved at retirement, which do you do, the Roth or the traditional, and why? And why?
Because it goes in after tax, and you're at a lower tax bracket right now. And the hope is that when you're retiring, you're at a much higher tax bracket. It's coming out tax-free.
So actually, regardless of tax rates, if your goal is to save the maximum amount spendable for retirement, the Roth is, because you pay your taxes on the Roth outside of the retirement vehicle, so you're actually saving more money for retirement. But your ideas are right here. Okay, so those are the 4 things that we like. Soon to be graduating students, what should you guys be doing? Devin says, enjoy the journey. Here's just some thoughts. Number 1, be organized. I love electronic systems such as Quicken and Mint. We do all of our stuff. How about this? If you go to some place like Nauvoo and you're serving for 6 weeks on a purely volunteer basis for the church, can you deduct those expenses? I can't deduct my time, but I can do food and room and board and things like that. Electronic system just makes it easier. So at the end of the year, what I do is I just print out. These are my things here, and I've got all the information on the. I've got all the backup for it, so it makes it easy. Number 2, keep prior year's return. I like to look at a prior year, so I make sure that I have to do the same thing that I did previous years. Will the IRS catch you if you make a math mistake? I've made a number of math mistakes in my time here. Yeah. But if you keep previous returns, you can kind of see what you've done on previous years. And again, we talked about you need to keep your tax records for a minimum of 7 years. Third one, I like each year to just keep good records so you can itemize deductions. My wife and I have a folder just on the right side of her desk, and whenever we do anything tax, we just throw it in the folder. And then come around February, March, we just pull the folder out and start doing our taxes. But it's nice having everything where it is. Get good at showing non-cash charitable contributions, miles. You know, if you're a young women's president, you go to girls' camp, you don't get reimbursed, you can do those miles. Scoutmaster, you don't get reimbursed, you can do those miles. Yes?
So how do you keep track of what does the
IRS recommend of how you actually organize, I drove X miles on this day? You just kind of type it up?
There's apps you can do. I kind of document it with my journal. It says, okay, I went to scout camp. It's this number of miles. I was a high council speaker. I drove from Walnut Creek, my home, to the Stake Center in Oakland. I did it twice a week. And I just figured out the miles, multiplied that, and I could justify it. Yes?
How would you go about like donating those investments to the church?
If you go look at Learning Tool 8, it's exactly the one that I use, and it's an example there too. The one you've got to remember is well, let's just show you that. In fact, I should have hyperlinked it in here. I'll hyperlink it in.
I just use Google to calculate mine. It's not sophisticated, but it
Okay.
Good
Okay.
free apps out there too, I guess if people are super worried about figuring out, but journals work too.
So here's kind of the same thing here. So this is the one I use for Schwab. This is the person. Confirm the transfer in the account. And I tell them what time. I call them up and I tell them we're going to transfer it. And it's at this time and this is the number of shares. So, and you want to do, in each of the brokerage places, the church has an account. So you just call them up and say, hey, what's the church's account? So account number 25 for X shares at tonight's NAV of, here, which is roughly this. It used to be that you could tell them to do a certain amount, and now they won't do it. You have to tell them, I want to donate 25.623 shares. And then the other thing that you do here is I always start with tithing first, then fast offering. And the reason being is what happens if the next day the price of the share drops? Now, you don't care because you've already donated it, but I want to make sure that my tithes and my fast offerings are the correct ones. So the last one's there. So I just usually put tithing first. And then what I do is I take this and I send it to the church as well, because they'll get a notice, hey, we're from Charles Schwab, we got 25.613 shares. And so if you send your email, a fax to them or an email to them, they'll look for it and they'll know, okay, this is for this Bryan and Ann Sudweeks account. So that's just the way that I've done it, and there's some more information there.
So,
Dakota.
This might be my ignorance again, but I'm a convert, not from Utah. Is this like a well-known thing, or is this less so new to me?
I don't know many people. I learned it from Roger Rice in Walnut Creek, California, and he did it. And so, in fact, Roger's at UVU now. He's still a great friend. But I learned it from someone else. Pardon me?
My bishop told me.
Yeah.
But it's not super well known.
Not super well known.
I think because a lot of people don't have investment.
Yeah. So, but people in my class know. Matt,
What allows the church to not have to pay a capital gains tax?
it's a 501c3. So,
That's right.
yeah.
It's 501c3.
Yeah. Okay, and then the last one,
These are just some charities.
yeah, just a charity.
You don't have to.
So I like in December set time. So the nice thing of buying index funds, and you have, if you've got one fund that's grown a lot, and you've got distributions there, what you do is find your index fund that's done the worst. So let's say it's internationally. So sell it out, recognize the losses, and then go buy it from a different company. You sold out your Charles Schwab index fund, now buy the Vanguard, international index fund. But the nice thing is it's not a wash sale, because you're not buying the same security, but you're buying this, gives you the same exposure to the asset class. Realize you can deduct up to $3,000 per year in capital losses in 2019. We talked about paying your tithing with appreciated long-term capital assets. Again, if you just click on that, that brings up the learning tool we just showed. Okay, questions on tax and tax strategies?
For,
Tyler.
The Roth funds, is there a required minimum distribution?
Nope. Actually, there may be with a Roth 401k, but by the time you get worried about it, it'll be fixed. So, things here. Okay, so let's talk about putting together your tax plan. I couldn't get this to work earlier. We'll see if we can get it to work now.
Taxes on my toothpaste, I pay taxes on my soap. And taxes on my loofah, I don't have one of those. And taxes on my car and on my morning cover show. And taxes on my gasoline, oh hey look, it's a toll road. Finally get to work, it's payday, hey, but what the heck? Seems the government done took some taxes from my check.
So, we've gone through doctrines and principles. We've gone through different ideas. What are concrete ideas to help us save money with our taxes? So first of all, what's your vision for your taxes? I remember when, during the presidential elections, people were complaining that Romney was paying less in taxes than his secretary. And it made it seem like, wait a second, it made it seem like taxes were voluntary contributions, but they're not. They're enforced exactions. So what goals do you guys have for your taxes? Matt?
Say, I mean, it's broad, but just, I like what you said, don't pay a penny more than you're supposed to pay.
Don't pay a penny more.
Pay full.
Yeah. But you want to show by your actions that you have integrity. You want to show your kids that you follow through. So honesty is probably one of the most important. But you want to use taxes strategically. So we'll talk about some ideas in retirement that you can use to save taxes. Maximize all after-tax cash flows, pay bills when due. Okay, so what are some plans and strategies before retirement? Yeah, David.
Start investing properly for the long term.
Yeah, invest for the...
Appreciate investments that you can use for either
Right.
charitable strategies or retirement strategies.
So this is the thing too. So you want to have both assets both in retirement accounts and taxable accounts, because you can't use that retirement accounts until age 59 and a half. So be wise. So you actually want to start having some balance. You should have we call tax now accounts, which are kind of brokerage accounts, tax deferred accounts, which are kind of your 401k, 403b, and then never a taxed accounts, which is your Roth. And so if you can start putting money in each of those three buckets, when you get to be an old guy like me, you can start targeting your tax rate in retirement. So things like that. Other thoughts? We're all tired. It's afternoon. We just ate. Got a lot of Mac students here. What are some of your strategies for how you're going to... Michael's laughing. So Michael, what are some of your strategies?
I'm laughing because I'm in the audit program.
Okay. See, I'm a finance guy and I can't avoid tax or audit, so here's just some ideas too. Keep good records. What my wife and I did is every third year we'd get help. We go back to H&R Block. We didn't have the Vita Lab like you have here. Volunteer income tax assistance, tithes and offerings. And we talked about using appreciated securities as a strategy to rebalance your portfolio. So you pay your tithes and offerings, you find your funds, usually which is equities that's outperformed, you use those to pay your tithes and offerings. Take the money you would have spent, and then you buy your underweight asset class. Are you selling high or selling low with that strategy? So you're selling your asset classes that have outperformed because they're a greater percentage. So are you selling high or selling low? Yeah, you're selling high. And then since you're buying the underweight asset class, those are the ones that have underperformed, you're actually buying low. So is that a good strategy for us? Yeah. Be balanced in your investment portfolio with taxable, tax deferred, and tax eliminated account. We talked about taxes here. Give me a strategy that once you retire, that you can target your tax rate in retirement. Let's say I want to target my tax rate at 12%. Do you guys remember what the top of the tax table was? What was it, like 78,000, something like that? What's my standard deduction? 24. So let's add 78 and 24, and what does that mean? What's that add to? Isaac's. Let's say roughly $100,000. So I pull money out of my tax now account, so my brokerage and things, so I get an estimate on how much I get out of that. Then let's say I pull another $60,000 out of my tax deferred account, which will take me up to that 70, and anything beyond that I just take out of my Roth accounts. So I can target my tax rate in retirement. Okay, so that's before retirement. We talked about plans and strategy, add in during retirement. We talked about target your tax rate in retirement with taxable, tax deferred, and tax eliminated accounts.
What is that tax harvesting in December or something?
So what happens is, let's say you have two mutual funds. One's done well and one's done poorly. So one's bought it at 10, it's up to 12. One, you bought it at 10, it's down to 8. So if I'd sold the one and so I got a $2 gain, I could also sell the other one and got a $2 loss, and I wouldn't have to pay any taxes on that there. So you just kind of, we call it tax harvesting. And the nice thing with index funds, the one that underperformed, say it's international. So I sell my Schwab International Fund and I buy my Fidelity and my Vanguard International Fund. So I still have exposure to the asset class, and now I've just eliminated that, or I've just reduced my taxes there too. How about this one? My wife and I will be on a mission in November of next year. What's a mission? We're estimating it's going to cost like about $4,000 a month. So over a year, how much is that going to be? Roughly $50,000. Okay, how much income are we going to make on our mission? Hopefully none. Would that be a good time to move money from a traditional 401k to a Roth 401k? So my taxes is just what I bring in. So what would happen if I brought in $100,000 of money from my 401k? I'd pay taxes on that, right? So I've got $48,000 in expenses, plus I've got my standard deduction, which is $24,000. So that's roughly $75,000. I pulled in $100,000. I'm only using $50,000. So what if I took that other $50,000 and transferred it to a Roth IRA? What's my tax rate going to be on that $100,000? So 100 minus 50, roughly 25, taxable income of $25,000. It's barely above the 10%. So I'm going to be somewhere between 10 and 12%. So is that a good thing? Is that a good strategy to have while you're on your missions? Kind of move money from taxable to retirement accounts, or tax deferred to retirement accounts, tax deferred to tax eliminated accounts. Should we have strategies like these? Other plans and strategies that you could use. Yeah, muni bonds, tax-free. Save money for your kids in education IRAs and 529 plans. Because if they use them for qualified educational expenses, you pay no federal or state taxes on them. So it's like Roth IRAs. We're accountable for the decisions we make. And one of the general authorities says, with increased information comes increased inspiration. The more we know, the better the decisions we can make. Other thoughts, other plans and strategies. Michael, you've always have some good ideas. Other thoughts that you're thinking about on the tax side?
Well, this is the reason why I'm in this.
Okay. But it is fun to kind of think through these issues. And normally, I mean, even our Mac students here, you normally don't get a chance to say, how does this apply to me? And now what we're doing now is we're trying to say, how can it apply? Tyler?
I guess you could do some things for estate planning. I don't know if you talk about that.
We will. We'll talk about I call it advanced planning, which includes wills and estate planning.
But part of that is like giving gifts to your children.
Right.
So that's tax-free.
Right.
After your death.
Right. Do that, but make sure you have everything you need first. And then, go ahead, Michael, you're going to say something.
One of the things that I'm learning here, and the principle is that maybe you think that these things are only what the rich people do, or that you will do once you have money. And I'm realizing that I should have been doing this a long time ago.
Yeah.
Even with a smaller amount of money.
That's right.
And now, trying to figure it out with more assets.
And again, if you guys can put your plan together that's articulating these things, all you got to know is, hey, I want to have a balance between taxable accounts, brokerage bank accounts, tax deferred accounts, which is 401k Roth or 401k IRA, and tax eliminated accounts, which is Roth 401k and Roth IRA accounts. Because I know that if I have a balance there, then I can target my tax rate in retirement. So these are just kind of things you need to think about. Instead of getting to age 63 and a half and you realize, wait a second, I don't have any money in my tax eliminated accounts. Realize too, one of the strategies I have, BYU has this wonderful thing called this Roth 401k. Even though my tax rate's high, I want to save more spendable money for retirement. So I'm not quite living on my BYU income. I'm living on my income, but not my BYU income. We won't go there. But so what am I doing is I'm taking money out of my taxable accounts, and how much can I put into my Roth 401k? What is it in 2019? 19,000. And if you're a part of the OGC, the Old Geezers Club, you can put another 6,000 in. Yeah, so we can put 25,000 there. And then plus my wife and I can also do 5,000 plus another 6,000, so 6,000 each into a Roth IRA. So in essence, what are we doing? We're exchanging taxable money for tax-eliminated money. And so we're trying to build up those things there too. Matt?
I'm just curious, so, I mean, like I understand the benefit of investing in a Roth
Okay.
now with our lower tax bracket, and assuming that when we're retiring, pulling the money out, that
Okay.
we'd be in higher bracket and eliminate that.
Okay.
What's the benefit of transferring money, like, you know, at a stage of life where your tax bracket may not change? Because wouldn't you still just be saying
You
paying
could.
the amount of tax that you're putting in it?
The assumption is your tax bracket will not change. What do you think the odds are taxes are going to go down in your lifetime? Raise your hand. I want to see it high.
Okay.
That answer your question?
Yeah.
And we'll spend more time on the Roth. There's really 8 questions to ask when you're trying to decide between a Roth and a traditional, and we'll go through that. But I hit that main one. If your goal is to save maximum spendable amount, regardless of tax rates, then the Roth is the better way to go. Okay, we talked about constraints. The biggest one is not living on a budget, laziness, getting caught up in the things of the world, and things like that. Okay. Any questions on how to do that? Do you think if you put a wisely thought through tax plan, Devin, do you think it can save you money in the long term? Okay. The good news is I can say it as long as I'm looking at both of you. I'll get one of them right. Okay. Okay. So let's see if we can do this. Let's divide the class right down in the middle. You guys are going to do the tax, the itemized deduction. Nathan, you guys, and Ethan, you guys over. You guys are going to do the standard deduction. So what we want to do, and I'd actually encourage you guys to use Learning Tool 39 to see if it works well. Okay? So here's just a note. Here's the Learning Tool off to the side. If you want to do itemized, click there. If you want to do standard, you click there. So you're welcome to use the Learning Tool. You don't have to. Learning Tool 39. Let's give you guys about 5 minutes to work on this, and then we'll take you through it. Click right here, standard. So notice the nice thing on this one, you can actually do 2018, 2019. You can see how your tax rates change over time. You can do married filing jointly. You can do head of household. Again, I'm having way too much fun with my Excel spreadsheets. Things like that. While you guys are doing this, I'm going to come and grade binders while you guys are working on it. Let's give you 5 minutes on this. Thanks, Daniel.
I have to explain my picture.
Is this, where's that, Spain?
It's in Brazil.
Brazil.
Because you said the picture should be something we love to do.
Uh-huh.
And I thought,
I love to eat.
eating a good meal
And being-
in a beach town in a foreign country.
I like it.
Okay, good.
Okay. It's all right.
Is it really like 100,000 years? Is it your office, right?
Yeah, so here's what I'm doing. I'm going to sign it off. But when you hand it in, if you don't have them, I'll know it.
Okay.
And that way you don't have to bring it in.
So now I need to figure out like which kind of more and all this stuff.
Yeah, it's pretty cool. I mean, we dive really deep into this class, so sometimes it doesn't feel applicable because it's just like crazy stuff, but like it's important. Not all of it is rich people problems. That's for sure. We use
I think you'll find that the learning tool helps. So the nice thing about the learning tool, it also calculates your refundable and non-refundable credits too. So it makes it quite a bit easier for us non-accounting people. It makes it a lot nicer. Anyone have a binder here you want? I was trying to figure out where it is. Is that Hawaii?
No, that's in
Spain.
Spain.
Sorry, if I've never been there, I can't guess. Looks wonderful. Okay, title page. You don't right. I will know when you hand it in if it's not done, so you don't need to. Okay. You know what? I'll sign it because, like I said. Okay. Dakota, you'll put it in by the time. Okay, Ammon. Crab. Where's this? Korea. I love their night markets. Korea, there's people out all hours of the day and night. And they're bulgogi and kalbis. Okay. Uh-huh. Current assets. Anything less than 12 months. So what happens is now with a mutual fund, because you can get your money out of a mutual fund in 3 days, all of a sudden you've taken a long-term asset and made it a short-term asset because you can get your money out. But generally the traditional fund is if you can pay it off within 12 months. That's considered a current asset. Or a current life, or you could, current assets, you can convert it to cash very quickly. It's considered a current asset, so you can access this. Okay. No. Yeah, sort of like 12 months. Okay. Janelle, do you guys have standard or itemized? Were you guys itemized? Okay, so we have you guys take us through it.
We didn't finish, but we can maybe go.
Janelle, why don't you come up and put it on the spreadsheet? And they can talk us through it, and then you can do the spreadsheet there.
You want me to just type it up while you guys comment?
Yeah, so we'll tell you, you can show us how it's done. So, Trey, Connor, and Matt.
Come on, team.
Okay, come on, the rest of the team. Okay, so they're doing itemized, right?
Yep.
So tell her what she should be putting in.
So for our wages, we've got
80 grand. You don't have to put, okay.
Oh, I don't need for the comments.
You don't need the comments, but that's all right. It recognized it anyway.
Okay.
What else?
investment income, we've got 10,000.
Investment income, 10,000.
We didn't have any education connected.
No education.
They had a $5,000 contribution to 401k.
So 401k, $5,000. So what is their gross income? Do you guys use total income or gross income more? Gross income. That's kind of what I use. Okay, so 85,000 is their gross income. Okay. Did they have any adjustments?
The flex spending plan,
So you had a flexible spending account,
2,500.
$2,500. That's down at the bottom. So that gave you your AGI of what? 82.5. Okay. So what else do we do now? So we're itemized. Let's work on, let's just kind of go down. Any charitable contributions? So 9,600 for charitable contributions. How about state and local taxes? 11,000, but how much can you actually use? 10. No, not there. Escape. Escape. Put it over. We only do it in the green stuff, so move it over to right here. So notice she put, so you can put 11,000 in just to show what the, no. 11,000. Enter. Okay, we lost that formula. Lost the formula. So let's just do Control Z a couple of times. Hold on a second. Okay. Now put 11,000 right there. Okay. So notice 11,000, but they only allow you to deduct that 10,000. Anything else? Any home mortgage? 6,800. No other taxes. Any charitable mileage? Nope. Any job related? It's not deductible. I probably should take that out, but I left it in there just because. There. How about medical expenses? 9,063. Now notice you can only deduct anything above 10%. So 8,250. So that's 82. So she can only deduct $813. Notice, because of that, you've got a number of things that are based on your AGI. So if you can reduce your AGI, it allows you to deduct a little bit more. Okay, so what's their taxable income? 55,287. Okay, let's come down a little bit more. So nice thing about this, it calculates your first taxable income, 10% on the first 19,400, and then 12% on the difference there. So you've got 6246 is your total tax liability. So is that what they have to do? They have to pay 6246?
No.
What did we forget?
Credits.
Okay, what credits do we have? So how many child tax credits? 3, so just use the drop-down box. Any other credits? Yeah, there's one more. No?
That's lifetime learning.
No.
No?
On this one here, we don't give you any information on those. So what about the one child that's in college that's under 25? Can they do a family credit on that one?
Oh, they can.
Yeah, they can. So one there. So notice. So you've got 6246. If all of these credits had been non-refundable, how much would they get back? If the credits had been non-refundable, they would get back 0. Because the credits can only, non-refundable credits can only bring you to a 0 balance. But because child tax credit is refundable, how much are they going to get back? $254.
What's the order that works? So for instance, you have, let's say, before you get to step 4, you're at 2,000, and then you step into step 5.
Okay.
You have 2,000 in child tax credit, but 500 in family credits. Does it apply 500 in family credits first, which is non-refundable, and then the child tax, or child
No.
tax first?
Basically, what we did here in the math, and I'm not sure this is the right way, because there's 0, because none of it's refundable, with the assumption is we're going to use that one first. And then because these are refundable, we'll use that one second.
Okay.
So the math is,
So you get
yeah, you get to choose. Yes?
This is also assuming that every paycheck they received, there was no withholdings.
Yeah, yep.
So, which is uncommon.
Yeah, so again, part of this is just the math. If you can understand kind of the big picture here. Okay. Is this the right answer? Do you want to just put it over on the PowerPoint there? Okay, click there. No, right, okay. So, standard deduction. Well, we did standard deduction first. Does everything look good so far there? Now, can you just do me a favor here? Do Control Z. Yeah, because what I was just going to show you how. Sorry. So, So we're going to make, Janelle is just going to show you how easy it is to change that from itemized to standard deduction. So come over here and let's do the standard deduction. That's also about line 26, drop down box.
Okay.
Come over. So that drop down, click and do standard deduction. Notice now the standard deduction, and it comes through with 84. Let's see if, Janelle, thank you. Can we have a big hand? So let's see if that works. 82.5 minus the no exemptions now, gives you your taxable income. Do it on the tax table, 65.84. And so basically there's 84 bucks. So they owe $84 in taxes. Is that what we showed from the worksheet? Yeah, 84. Okay. We also went through this one, that was 284. So if we do itemized, 254, sorry. 254 taxes. So what's their marginal tax rate? Both of these, in both of these equations. Both of them is 12%. Average tax rate, so they pay 84 on 85,000.1% itemized. They actually get money back, so it's 0. So the question now is, what are your recommendations? So we've gone from data to information. So now we have both of these charts. Information to insights. What's your recommend? Would you itemize or standard deduction or itemize? Now, itemize. And why? Insight is you save 338 bucks. Okay. So what could they do to reduce their taxes? What recommendations would you guys have? And I'm not going to show you the PowerPoint. So you guys make the decisions, and this will be our last thing for the day. Right, so what they could do is they could keep better records because they could find out, because you've got the child it's in school, you probably could get some American Opportunity or the investment, there's some 3 or 4 different credits that you could take. So just keep better records, yes?
I would suggest for them, under the itemized, we have a total itemized deduction of $27,213, which is a few thousand over the standard. Now, if instead they had bunched their charitable contributions, let's say doubled it.
So what happened if they doubled it? Let's say they paid 2 years of tithing at one point. Let's look and see what that would have done. See, that's the nice thing about something like this. Let's say 20,000. Notice it's up to 37. So if they would have bunched contributions, would that have had a significant impact? Now notice they would have gotten 1502 back instead of the 284.
And then next year they can still take the standard. If they pay no charitable contributions next year under the same scenario, they'd be under the standard, so they can still take the
They can still take the standard next year. So they can pay their tithes on December 31st. They pay for the next year plus the previous year too, and then you'd get a huge tax hit. Dakota. Yeah, you can bunch 2 years, or you can bunch 3 years. I don't think the Lord cares. You could. So as long as the Lord knows and you keep good records. Other suggestions, Jessica.
On that step 6, where it says the amount withheld, that's the amount withheld from your paycheck.
Right, and they didn't have anything withheld. So, yeah. So in cases like this, if you have, when we used to have 7 kids and we got 7 child tax credits, that's $14,000. We paid hardly any taxes for years and years. And now we're our youngest, we're empty nesters now, and we're paying through the nose. So is my tax rate rising in retirement? Yes, significantly. So, okay, so when you figure out what your tax rate now versus retirement, take into account your child tax credit and things like that. Other recommendations?
Okay.
Yeah.
So I was just telling you just really watch it, right? Especially when you have investments, because we had something sell, like the stock just cashed out all of their stock, but it was the end of November, so I'm taking finals and it's the end of the year, right? And I would have, had I seen it, I would have sold a whole bunch of losses
To offset it.
to tax harvest it.
And
But I didn't see it till April when I was doing taxes, and it hurt.
You know what we call those?
So you really do want to be watching watching everything at least monthly.
It's called stupid tax. And I paid
That was a huge
I paid lots of stupid tax in my life. We had money in a custody accounts, because when I set them up, custody accounts were good because it was taxed at the child's rate. And when they turn 21, it goes over to the kids. Well, I didn't, that didn't seem bad to me, and so my daughter got this thing, a tax bill that says, oh, you owe $2,000 because the money in that account went to you. And so I just paid it, something like that. Another child, I paid it again, and I was talking in this class, and one of the students goes, wait a second, that was in a custody account? Yeah. How often do you do it? I said, well, I put a chunk of money at the beginning, and so the last 20 years it's just been appreciated. They said, just show them the basis on it. So it's basically, you have had no capital appreciation on it. And so the basic thing is it's all capital gains. And so they should pay zero tax on it. So I paid $4,000 in stupid tax because I didn't understand the tax rules. Okay. Dakota, you're the last one, and then we got to do takeaways because it's time to go.
Yeah, I'm sorry. So I wanted to ask, you mentioned something about tax withholding, whether it was good or bad?
Well, ideally what you want to do is you want to do your W-4, so when it comes to time to pay your taxes, you owe zero taxes.
Or owe just a little.
Or owe just a little bit.
Better than a refund.
That's right. Refunds are bad because you're giving no interest loan to the government. Okay, takeaways. Dakota, is that a good answer?
Yeah.
Okay. Takeaways. Takeaways from today. Janelle. Yeah. Be wise and keep records, and it'll help you save a lot of money. Matt.
Be current on tax rules or have good friends that are.
Yeah. Be current on tax rules or have good friends that are. That's why every 3 years I like to go back and have someone take a look at it. Other takeaways.
Yeah, I had an accountant once that told me a law in 2011 that had expired in the 80s. So.
Make sure your people you work with are current on the law. Okay. Other takeaways?
Just like distribute money to all different types of tax
Yeah.
accounts.
Right. Try to have tax now accounts, which is brokerage, tax deferred accounts, which is your 401k, 403b, IRA, and never tax accounts, which is your Roth 401k and IRA. And that way you can target your tax rate in retirement. Let me just share my takeaways for today, and then I'll let you go. Number one, pay everything you owe and not a penny more. We're a law-abiding people, but we only pay with what's due. Taxes are enforced exactions, not voluntary contributions. 2, understand the process. Ignorance is expensive. I know, I paid $4,000 in extra taxes. I call that my stupid tax, and I paid lots of stupid taxes. Number 3, do the things in life that are important to you. Realize it was never between you and them anyway. Thanks, everyone. We will see you on Monday.